Welcome back to Iron Financial. This is the explainer where we help you forge a visibly stronger portfolio, cut right through the relentless market noise, and identify the actual load-bearing pillars of the modern economy. Look, let's just address the elephant in the room. Right now, the macroeconomic climate is brutal. It's unforgiving. We're staring down sticky inflation, wildly shifting interest rate expectations, and a general tightening of capital that is absolutely exposing the weak, crumbling foundations of countless companies out there. I'm your lead analyst, and today we're looking at a business that is either building the infrastructure of the future or, quite frankly, constructing the biggest house of cards on Wall Street. We are diving deep into the structural integrity of Palantir's explosive Q1 2026 earnings. Let's get straight into the numbers, because out here, only the numbers are forged in iron. And I'm your market skeptic. I'm here because this market is absolutely flooded with noise right now. I mean, it feels like every single company with a rented server rack is slapping an AI label on their pitch deck just to pump their stock price. We really need to know, is Palantir actually delivering the goods, or is this just another massive rally built on empty promises and thin air?
Because look, the audience is seeing Palantir's stock chart going absolutely parabolic. And honestly, alarm bells are ringing. We've seen this exact movie before, haven't we? We've seen the AI slop, the vaporware, the hype traps just waiting to collapse the exact moment the market actually stress tests them. We have seen countless tech startups burn through literally billions of dollars implementing generic language models, only to realize there is absolutely zero return on investment for their enterprise clients. Everyone is talking about artificial intelligence, but talk is incredibly cheap. Is Palantir actually building a solid foundation, or are they just cashing in on the buzzword of the decade? We demand to know if this foundation can actually hold weight when real pressure is applied. And honestly, that is exactly the right question to ask. If you're going to allocate your hard-earned capital in this environment, you cannot build your portfolio on sand. You need concrete. And what I'm about to break down for you is definitive, mathematical proof that Palantir isn't just casting shadows in the AI space. They are pouring thousands of tons of high-grade commercial concrete.
Let's drop the hammer on this right away. 85%. That is Palantir's year-over-year total revenue growth for Q1 2026. Just let that number truly sink in for a second. In the current macroeconomic environment, where other legacy tech giants are seeing their growth stall out into the low single digits or even contract, Palantir is accelerating. And we are not talking about a microcap startup finding its first few clients and experiencing some cute base effect bump. No. We are talking about a mature, multi-billion-dollar enterprise accelerating its growth at a rate that completely defies gravity. This single number proves they are delivering real, undeniable, hard value to their clients. Because listen, if the product didn't work, this level of scale would be mathematically impossible.
Look at the financial blueprints we've pulled directly from the earnings report. Total revenue surged from $884 million in Q1 of 2025 to a staggering $1.63 billion in Q1 of 2026. This represents the highest revenue growth rate Palantir has ever reported as a public company. Period. But what you really need to focus on is the consistency here. This marks 11 consecutive quarters of accelerating revenue growth. Unbroken momentum like that tells us management isn't just getting lucky. They have built a repeatable, highly scalable engine. Furthermore, the U.S. revenue alone hit $1.28 billion, increasing 104% year over year. Think about that. That means the U.S. operations now represent a dominant 79% of their overall business. This isn't a gradual incremental climb. This is a structural explosion in enterprise demand.
Market Skeptic. Okay, hold on. $1.63 billion is a massive number, for sure. But let me stop you right there and bring some reality back into this room.
For years, the heavy knock on Palantir has been that they are overly reliant on the government. Critics have long argued they are simply a defense contractor masquerading as a high-growth tech company. And look, government contracts are sticky, sure, but they come with massive risks. You're dealing with changing political administrations, continuing resolutions, threatened budget cuts, and notoriously slow procurement cycles. If this foundation is going to support a massive valuation, it cannot just rest on the Pentagon. I need to see if commercial adoption is actually bearing any weight, or if this is just the exact same old government story repackaged for a new year. I am so glad you brought that up, because the commercial numbers completely destroy the government-only myth once and for all. Yes, U.S. government revenue is a fortress. It grew a massive 84% year over year to $687 million, which is incredible on its own. But look right next to it on the slide. U.S. commercial revenue hit $595 million, surging an absolutely explosive 133% year over year. And it gets even better. Management explicitly noted that commercial growth would have been 143% if not for a major customer program transitioning to the government side. Let that sink in.
When a program shifts like that, it proves the commercial software is so effective, it becomes a matter of national interest. What we're witnessing here is a massive structural shift in the entire business model. The commercial engine is not just running, it is roaring, and it's catching up to the defense side at breakneck speed.
And hey, it's not just existing customers spending more money. Look at the heavy lifting they're doing in brand new customer acquisition. The U.S. commercial customer count surged to 615. That's a 42% year-over-year increase. Overall, they just crossed the 1,000 customer milestone globally. But what makes this fundamentally and structurally impressive is how they are doing it. CEO Alex Karp noted they have a functionally non-existent traditional sales force. They mention only about 7 of their salespeople actually even really sell. Think about the financial implications of that for a second. They are saving tens of millions in capital by not funding a bloated enterprise sales department, and they're funneling that massive operational leverage straight back into research and development. They are acquiring these enterprise customers because the product is an undeniable load-bearing necessity, not because of slick marketing.
All right, I'll admit the commercial numbers are accelerating, and the sales efficiency is undeniable. But let's get back to the actual technology for a second. The broader market is suffocating in what we call AI slop. You know what I mean. Chatbots that hallucinate basic facts, thin wrapper software built on someone else's API that adds literally zero real value. How do we know Palantir's artificial intelligence platform, AIP, isn't just more of the exact same fragile code?
Because Palantir is building from the bedrock up. Listen to this quote from Karp right here on the screen. They stuck to their guns on building an ontology. For the non-engineers watching, an ontology is the unified data schema that underpins their platforms. It is the architectural blueprint that connects raw data to real-world business logic. Chief Technology Officer Shyam Sankar explained that we are seeing a true Jevons paradox in AI right now. The Jevons paradox dictates that as technological efficiency increases, the demand for that resource explodes. Because token costs for large language models are dropping massively, the demand for enterprise AI compute is going through the roof. But if you try to orchestrate AI agents and execute automated workflows without an ontology, you get catastrophic errors, you get data leaks, you get hallucinations. Palantir's AIP provides actual, measurable, regulated structural integrity for enterprises. It's not beta software, folks, it's alpha generation.
Let me give you a concrete, heavy-duty example of this working out in the real world. Palantir recently locked down an up to $300 million ceiling contract with the USDA. This isn't some cute pilot program to help write polite emails. This is a massive, multi-year deployment to secure American farmland, enhance supply chain resilience, and shield agricultural programs from multi-million-dollar fraud and abuse. Because at the end of the day, food security is national security. By securing the agricultural supply chains, Palantir is proving that their software isn't just another convenient app. It is functioning as a load-bearing pillar for vital national infrastructure.
Okay. Protecting agriculture and serving the government, that's fine. But show me the proof in the cutthroat private sector. Show me a purely commercial enterprise using this software to forge a noticeably better bottom line. Oh, I will do you one better. Consider their massive new partnership with Modern. They're using AI to literally modernize the entire home lending industry. They are bringing deep ontology and agentic AI straight to the mortgage process. The chairman of Modern stated that this strategic partnership will fundamentally reshape the future of the industry. They are entirely revamping the end-to-end mortgage process, cutting through decades of legacy banking inefficiencies. And when you strip out that operational fat, it translates directly to massive profit margins for Modern, while simultaneously lowering borrowing costs and expanding access to homeownership for millions of Americans. This is technology creating intense operational efficiency in the private sector. It's a real game changer.
And when we talk about operational efficiency, let's examine the hard metrics from their defense work, because that blueprint is translating directly to their commercial playbook. With the Navy Ship OS, Palantir reduced key manufacturing approval processes from 200 hours down to 15 seconds. Let me repeat that because it frankly sounds impossible. 200 hours of bureaucratic friction reduced to 15 seconds. They increased contract review cycle speeds by up to 73% and cut monthly material planning time by an astounding 94%. They are fundamentally rewiring manufacturing and supply chain processes. Think about the commercial implications here. If they can rewire the supply chain for a United States Navy warship, imagine what they're doing to a commercial automotive assembly line or an international shipping logistics network. Look, those efficiency gains for their clients are spectacular, I will absolutely admit that. But here is where I bring the pain. What about Palantir's own efficiency? Any company can buy top-line growth if they're willing to aggressively burn billions of dollars doing it. If this hypergrowth is bleeding the company dry behind the scenes, then this whole structure is going to collapse under its own weight. I demand a look under the hood to see if this balance sheet can actually take the heat.
Section 1. Stress testing the margins. We're going to look at exactly how they're welding operational success directly to the bottom line. Let's get into it.
Let's rigorously audit this cash flow line by line. In Q1 2025, operating cash flow was a respectable $310 million. Fast forward to Q1 2026, a monstrous $899 million. Adjusted free cash flow skyrocketed from $370 million to $925 million. Look closely at that margin expansion at the bottom. Adjusted free cash flow margin went from 42% to 57%. What does a 57% free cash flow margin actually mean for the business? It means they generated more free cash flow in this single quarter than they had in total revenue just a year ago. It means they're generating so much excess capital that they can completely self-fund their aggressive hyper-growth. They don't need to take on expensive debt, and they absolutely do not need to dilute their shareholders to keep the lights on. They are a self-sustaining, cash-printing juggernaut.
And the structural integrity just gets even better. Point your attention to the adjusted operating income, $984 million in Q1 2026. That represents a bulletproof 60% adjusted operating margin. But even more importantly, look at their GAAP net income margin, which came in at 53%. Now, GAAP profitability is the absolute gold standard. It means they are making real, undeniable, highly audited money after factoring in all actual expenses, including stock-based compensation, which, by the way, is where many tech companies completely hide their losses. Let me remind you, they are achieving 85% top-line growth while simultaneously running a 60% operating margin and a 53% GAAP net income margin. In the software industry, finding a company that can balance aggressive scaling with this level of bottom-line discipline is incredibly rare. It is practically unheard of.
Which brings us to the ultimate metric of SaaS structural integrity, the Rule of 40. Now, the Rule of 40 simply adds a company's revenue growth rate to its profit margin. If the score is over 40, the company is considered to be operating efficiently. Top-tier elite software companies might hover around 50 or maybe 60 on a good day. Palantir just posted an untouchable Rule of 40 score of 145, up from 127 in the prior quarter. 145. I want to be perfectly clear about this. A score of 145 isn't just a good quarter. It is a structural anomaly in the software world. It completely shatters the broader market average. They have welded operational success directly to the bottom line, leaving almost every other tech company literally choking in their dust.
Okay, a 145 Rule of 40 score is undeniably impressive. But is this momentum actually sustainable? Are they just relying on a few massive, lucky government mega contracts that happen to hit this specific quarter? Because if the deal flow isn't broad-based across the entire industry, this foundation is brittle and highly prone to snapping. It is incredibly broad-based. Look at the heavy lifting happening down in the trenches every day. During Q1 2026, Palantir closed 206 separate deals worth at least $1 million. Of those, 72 were at least $5 million, and 47 were over $10 million. Total contract value bookings hit $2.4 billion, up 61% year over year. U.S. commercial TCV alone was $1.2 billion. And look at their net dollar retention, which jumped to 150%. Let me translate that for the audience. It means their existing customers are spending 50% more this year than they did last year. It proves the product is incredibly sticky. Once a company integrates this ontology, they radically expand their reliance on it. With the remaining deal value sitting at an incredible $11.8 billion, the forward pipeline is absolutely packed with iron.
And management's absolute confidence powerfully reflects this pipeline. They significantly raised their full-year 2026 guidance. Revenue target raised to between $7.65 billion and $7.62 billion, implying 71% year-over-year growth for the entire year. They raised adjusted operating income to over $4.4 billion. And most critically, they are forecasting U.S. commercial revenue to exceed $3.224 billion, representing at least 120% growth in that vital segment. You guys, in an economic environment where most companies are issuing highly cautious, muted guidance out of fear, Palantir actively raising their target is a massive flex. It is a testament to the undeniable, unrelenting strength of their customer demand across all segments. Okay, I concede the battle on the fundamentals. The growth is real, the cash flow is massive, the product actually works, and the pipeline is packed. But I am stepping in with the final, ultimate stress test right here. Valuation. Palantir currently has a market cap hovering around $350 billion. It is trading at a highly growth-dependent premium. We are talking roughly 48 times expected sales and over 146 times expected earnings. I don't care how much steel you use to build a company, can any foundation support that much weight? At 48 times sales, this stock is priced for absolute perfection. Any slight miss in future quarters, any microscopic crack in the armor, and the market could cause this massive valuation to violently collapse. Is all the future growth already priced in?
That is the multi-billion-dollar question, and you are entirely right to ask it. The valuation is sky high. There is absolutely no denying that reality. You are paying a massive, heavy premium for this growth. But you have to weigh those intense valuation dependencies directly against the ironclad fundamentals we just spent time reviewing today. You are praying for a company with a market-shattering 145 Rule of 40 score, 60% operating margins, and 85% top-line revenue growth. And let's look at the ultimate safety net, the bedrock of their financial security: liquidity. Palantir ended the quarter with $8 billion in cash, cash equivalents, and U.S. Treasuries, and zero debt. Let me repeat that for everyone navigating this high-interest rate environment: absolutely zero debt. In an era where debt servicing is literally destroying corporate balance sheets, having an $8 billion war chest and no leverage makes a company practically bulletproof to macroeconomic tightening. Yes, the valuation demands perfection, but this balance sheet is engineered to weather almost any storm the market can throw at it.
So, we've drilled all the way down to the bedrock today. We've examined the explosive 85% total growth, the incredible 133% surge in the U.S. commercial sector, the real-world impact of the AIP ontology securing our national infrastructure, and a self-funding cash flow profile that is the absolute envy of the entire software world. The numbers are, without a doubt, forged in iron. Market skeptic, but the price tag is incredibly steep. The multiples are intense, and the market expectations are now completely stratospheric. One crack in the armor, one missed quarter, and the market could punish them relentlessly. And that is the harsh reality of investing in elite growth. We've laid out the financial blueprints, we've shown you the structural integrity and the massive valuation weight it has to carry. Now it's up to you. Is Palantir the iron foundation of your portfolio, or is the valuation simply too heavy a burden to bear? True iron portfolios are built on hard data, not on market hype. Look at the numbers, cut through the noise, and decide how you will forge your own financial future. Thank you for joining us on this explainer, and we will see you next time on Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.